This podcast channel is about you, successful international entrepreneurs, successful expats, successful investors. Sponsored by HTJ Tax.
Okay, so we are live. Thank you for joining us this evening, afternoon, day, good morning, depending on whatever part of the world you're in. So we are going to talk about taxes for international entrepreneurs or digital nomads. I use the terms interchangeably because sometimes people think digital nomads is carries a lot of baggage and implications. So, but yeah, everyone knows what I mean. So we're doing this more or less every month now. So some of you may have seen this before on our YouTube channel, and some of us may have joined us previously. For those who've joined us previously, good to see you again. So the format will be more or less the same. I'm going to talk for about 20 minutes or so, go through some slides, and afterwards will be the Q&A. And I know that's the really important part because that's what brought so many of you here this morning, this evening, this afternoon. So without further ado, I'm just going to jump that 6 important things that I believe that the international entrepreneur or the digital nomad should be familiar with when it comes to taxes, right? Just to give you a bit of background about myself and my team, because I'm not a one person show. My practice is a semi autonomous unit within a larger practice called Moores Rowland Asia Pacific. So we have just over 30 offices in 12 countries. I am actually based in Singapore officially. This October will be 8 years that I've been based in Singapore. And because I am US qualified, I'm legally required to remind you that nothing that I say here should be construed as advice. We're having a general conversation about general principles. Consider it an education piece rather than advisory. And more importantly, nothing that I say here should be construed as encouraging you to pay less than your fair share of taxes in any jurisdiction in which you are exposed. And of course, we have it in writing, and this is how I stay out of jail. So thank you for bearing with me. So these are the takeaways. I'm going to talk about just probably six. The title is six things to consider. So I'm going to talk about six things, and then we jump into the Q&A. The first thing would be flag theory. And I know that there are a number of organizations who branded themselves flag theory, but my understanding that is that flag theory started was a term coined by a guy in the 1950s, and essentially is about diversifying your lifestyle. Where you are a citizen isn't necessarily where you are legally resident. May be different from where your company is incorporated. May be different from where your assets are stored, your cash, your crypto, and maybe a different jurisdiction from where you enjoy yourself. So it's the key thing is just like how investment 101 is that you don't have all your eggs in one basket. The same applies to your international business. You're not overly exposed to any one particular jurisdiction. Number two, fake news. So there are no doubt, there's no shortage of online influencers and gurus who claim to know everything about everything, which is fine. But I always advise caution when it is a decision with financial and legal implications. Typically you would want to get advice from someone who is legally qualified to give that advice. I think that should be pretty obvious. Now, what I've done is I've called out certain issues that I've seen misrepresented in popular or online landscapes, some of which we'll jump into in greater detail. Others may come out in the Q&A. Who knows? The third thing I want to talk about would be direct versus indirect taxes. So now we're getting actually into the tax piece. I think most entrepreneurs, I think most digital nomads are familiar with direct taxes. If you have a company, assuming the company is incorporated in a jurisdiction which there are taxes payable, then the company files and pays the taxes. And similarly, if you as an individual find yourself in a jurisdiction in which you are required to file and pay taxes, that much is obvious. You're required to file and pay taxes. What is less well understood are indirect taxes, and I think this is uh, it's something that is not well understood, but equally so, it's an area that is opening up to greater law enforcement in certain jurisdictions, whereas they may not have paid attention to it historically. Now it's a huge deal because, as you know, most governments are strapped for revenues, so every penny counts, right? So they don't let things slide anymore. So what I'm talking about would be like VAT in the UK and the European Union, GST in Singapore, goods and services tax, sales and use tax in the US. So basically, it is taxes that are not paid to the tax authority, like a direct tax. It's a tax where you may be required to collect this extra revenue from the person who's buying your good or your service, like in Malaysia, where you have a services tax, and you remit that on their behalf to the tax authority. So it's just something to keep in mind as you are your business models are evolving internationally. Your place of effective management. So this was flagged as one of the probably the first item where I was speaking about fake news, right? There's this misconception that if I incorporate a company in, for example, one of the tax-free jurisdictions, so BVI or Cayman, or an IBC, an international business company in Dubai, then you know what, I my company is tax-free. Not understanding that many jurisdictions have in their tax laws something called mind and management or management and control. What it basically says is that, for example, if you have incorporated a company in jurisdiction XYZ, doesn't matter where it is, but you run that company from Portugal, or you if from it, especially if it's in a low tax jurisdiction or a no tax jurisdiction, or one that's on the OECD blacklist, and you run that entity, you manage it from the EU, or any other company, you just manage it from the UK, or you manage it from Singapore, wherever you may be based, then the tax authorities in that jurisdiction may take the view with, hold on, I know your company's incorporated elsewhere, but you're managing it from here. So we deem it to be a domestic company. Uh, of course, you would ask the question, how are they going to know? Well, we're in the age of social media, and we've seen cases increasingly becoming common where social media brings undue attention to someone. So someone thinks, well, I'm managing my company from jurisdiction wherever I am. Who's going to know? I'm doing it online. I'm a remote worker. Yes, but you may be a YouTube influencer. You may be doing something on social media which draws attention to you. And that draws the attention of the tax authorities. And we can talk about that later on as well. And that is part of the whole concept of nexus, which is basically about having a connection, where you have a connection with a jurisdiction that creates a taxable presence. uh, it is a very nuanced definition. Typically it has been interpreted to mean physical presence. So if I'm physically present in a jurisdiction, it may constitute nexus. But what we're seeing happening in other jurisdictions, for example, oops, I skipped a slide. All right, in other jurisdictions, particularly in the US right now, what they're saying is that economic activity may constitute nexus. So, for example, those who are selling on Amazon FBA, You get your report from Amazon, and Amazon tells you all the warehouses in which they stored your product on the way to the final consumer. And typically that physical presence was enough to constitute nexus, and you file and you pay taxes. I'm talking about the indirect taxes, the sales and use taxes. What we're finding is that many jurisdictions, for example, and the case study being the US, they're saying, you know what, physical presence, it's part of it. It can constitute nexus, but we're also looking at economic activity. So if it is that you have if you're selling and you have consumers using that product in a given state or a given jurisdiction, well, we want you to pay taxes. Even though you're not there, your consumers are there, you are benefiting from conducting commerce online in that jurisdiction. And some jurisdictions go become quite detailed, and they speak about click-through nexus as well. If you're cooking, if you have if you're doing affiliate marketing in certain states, that can constitute nexus. So the idea of a taxable presence, I wanted to take away the idea of a taxable presence, can be very, very nuanced. It doesn't necessarily mean physical presence. Physical presence, hell yeah, definitely, but just business activity can lead to tax nexus. So now I'm going to talk about those who may be US exposed, right? And then I'm going to talk about the other advanced economies and then the rest of the world. And those are the three baskets that I tend to put people into. So the US is, of course, a special case. Why? As everyone who is US exposed should know, the United States, along with one other country in the Horn of Africa called Eritrea, those are the only two countries in the world where you're required to file and pay taxes regardless of where you reside. Other jurisdictions, by following certain procedures, you may be able to sever tax residency with that jurisdiction. The US, the answer is no. No matter what you do, you cannot sever tax residency with the US if you are a US person for tax purposes. The only way out is surrendering your passport or your green card. That's the only way out. But there are opportunities by immediately moving overseas. You have the opportunity to shelter the first $107,000 of your income from US taxes. And there's something called the Foreign Earned Income Exclusion, the FEIE. And that is a huge incentive. We're seeing people leaving California for Texas or New York for Florida, and you immediately, well, not immediately, with some doing, you get the opportunity to legally avoid state taxes, the 13% state tax in California, for example. You can take it one step further, and by leaving the US, assuming that you have been earning less than, let's say, 110 grand, that whole 110 grand may be sheltered from US income taxes. Something to think about. With the US, because of the way the tax net works internationally, it's different from domestically. Domestic, it's all about filing and paying taxes on time. That's the name of the game. Internationally, with the US, it's all about reporting. So if you don't file and pay taxes, you don't pay your taxes. I mean, yes, interest and penalties, but if you don't report that you have a foreign bank account, not only would you be incurring civil penalties, but also criminal charges as well. So they get pretty aggressive. And you're also required to disclose the activity of any company in which you hold beyond a certain threshold in terms of shareholding. Once you control a company, it is reportable to the US as part of your personal tax return. Now, people seek to circumvent this by using nominees. It doesn't work. It doesn't work. That is decades ago. That is old school. The IRS sees right through that, and if they discover that you have been doing it, you're gonna have some hurt. So it's old school. Don't do it. Doesn't work. Pay attention to your banking, as I mentioned before. You need to make sure you report all the bank accounts over which you have signing authority, even though you may not be the UBO, the ultimate beneficial owner. You are still required to file and pay taxes on it. Right. So I just needed to mute someone from whom we're getting some background noise. Please don't unmute yourself until we get to the Q&A. Report your banks and report the bank accounts over which you can sign for your company. Report your investment accounts overseas, your unit trusts, your mutual funds, your ETFs outside of the US, everything needs to be reported to the US. Estimated taxes. The IRS does not like to wait to get taxes at the end of the year. They want to get quarterly payments at least. So that needs to be part of the discipline, estimating what your income is going to be and paying taxes accordingly. And don't forget state taxes. And there's some, you have 50 different states, 50 different rules. Some states, most states are domicile states, and some states have more aggressive tax nets than others. And for us, the stickiest state may be Virginia. Even though you may be outside of Virginia for years and years and years, you may still be a tax resident of Virginia. So most what we tend to counsel our clients to do is, before you leave the US to work internationally, you would want to re-domicile yourself to one of the 9 states without an income tax. And just the most popular two would be, of course, Texas and Florida. But that way, you remove any possibility of states, taxing you in your absence, and on your return to the US, you're faced with a huge tax bill. I have some case studies that we can get into if necessary for the Q&A. The next would be the next grouping would be Kanzuk. I don't know. I saw that online and I thought that was an interesting acronym. But basically, UK, Canada, Australia, New Zealand. Now, we said that the US was the one jurisdiction where you cannot break tax residency. Increasingly, these jurisdictions are becoming sticky as well. So and this applies particularly for those who move around a lot as nomads, as digital nomads. If it is that you're not a bona fide resident of any other jurisdiction, these countries have a fallback rule. So if you're not properly resident somewhere, your center of life has not shifted from Canada, from the UK to some other jurisdiction, under certain circumstances, even though you're not there for years, maybe, you can fall back into the tax net of the CRA in Canada, or HMRC in the UK, or the ATO in Australia. So it is something to keep in mind and to speak with your advisor about. Most of Europe, there are the 183-day rules. So once you spend, a certain number of days outside of given European country, you tend to escape their tax net, but still certain paperwork may need to be filed. And some jurisdictions, again, like the cancer countries, are becoming quite aggressive. So for example, we've seen Italy in recent times say, hold on, if you're moving to a so-called tax haven, so we have clients in the UAE, in Dubai, we have clients in Malaysia under MM2H, my Malaysia second home, where they're resident there tax-free. And then Italy is saying, well, no, you need to pay tax somewhere. If you're not paying tax wherever you are, as a citizen of Italy, we're going to tax you back in Italy, even if you no longer live there. And other European countries do have we're increasingly seeing that rule, where if your center of life hasn't properly shifted and you're taxable somewhere else, you may, if that does not happen, you may still be taxable back in your European country of origin. So something to pay attention to and speak to your advisors about, right? And this gets into a bit more of the EU situation, and I give some examples as to the process is becoming, let's say, more involved to sever tax residency from your European country of origin, and you may be still tax resident for a certain number of years after you have left. So again, pay attention, get advice from someone qualified to do so. The rest of the world might be thinking, well, I'm not European, don't need to worry about those fallback rules. I'm not American, therefore I'm not subject to citizenship-based taxation. So I'm home free, right? I can live tax-free. Well, we have clients that have tried it and they've run into some problems. So what do I mean by problems? And the problems revolve around banking. And when you speak to tax advisors, they may be up to speed with tax rules, but they may not be au fait, or they may not be current when it comes to banking rules. Now, increasingly, banks are under a lot of pressure to prevent money laundering, and the KYC, or they know their customer rules, are becoming quite aggressive. And what does that mean? It means that you need to prove source of funds. And I'll give you an example. I'll give you an example of uh, a client that we had in Southeast Asia. He's a popular DJ, and try not to be too precise so people can figure out who he is. He is from a certain country. Now he's been living in and traveling in certain parts of Southeast Asia, and as an entertainer with certain nightclubs or whatever, and he's done pretty well for himself. And he had a situation where he wanted to return to his country of origin, which is fine, no problem. He's still a citizen. He has a valid passport. What's the problem? The problem is that he was banking in whatever country in Southeast Asia, and because he was moving around, he legally perhaps may not have been required to pay taxes. And when he tried to wire that money back to his country of origin, even though this was a bank that he has banked with since he was a child, or growing up, family, whatever, it the money was frozen, and it was returned to the country of origin, where the funds were originally wired from. Even though he can prove it was wired from himself to himself, and he called the bank, he said, "Well, don't you know who I am? Check online. I'm whoever I am." But they're like, "I understand, but how do we know that this money was legitimately earned? We don't know." You know, I give anybody 10 minutes and they can drum up an invoice on Microsoft Excel. Invoices don't prove anything. For many banks, what constitutes real evidence that the money is clean is a tax return. Is a tax return. So there's a strong possibility that if it is that you do move around internationally, and you legally, perhaps because of your situation, are not required to pay taxes, you may find yourself in problems with the banks. So we always advise clients, pick a country to be tax resident, pick somewhere to be your center of life. And we can get into that in the Q&A if that's necessary. So what should be pretty clear from everything we've discussed so far is that you need a team, and there's no way that one person could understand everything, all jurisdictions, all eventualities, all possibilities. So you're looking for a team of advisors who would be qualified and experienced in the jurisdictions in which you're exposed. So with that, I'm going to jump into the Q&A. Feel free at the bottom for those watching on Zoom. I'm streaming on Facebook as well, so sorry, no Q&A in Facebook. But for those on Zoom, there's a chat box in the lower right. Please feel free to key your questions in there. I will have a look at what's there right now. Okay, thanks to those who... All right, I'm scrolling down. Oh, whew. This is a great question. How to avoid falling under the guilty provisions when setting up a foreign entity abroad as a U.S. citizen living abroad. So this obviously applies to U.S. exposed persons, which, as we mentioned in the slides, are those that have arguably the most complex tax situation to contend with. Now, the IRS, Internal Revenue Service, they have a number of anti-deferral mechanisms. And what do I mean by that? For many business owners, the holy grail is the ability to run a business overseas, not pay any taxes, and have the ability to reinvest the profits. So you earn money and you're able to reinvest it continuously in your business, right? That's great, right? And only pay taxes when you extract money from it. Now, the government the U.S. government is obviously aware of that. So they have a number of laws to prevent the ability to defer income, because obviously, because that will put you at an advantage, let's say, to someone who runs a business within the US, right? Where, they make a profit every year, they need to pay taxes before they can reinvest what is left over into their business, right? So it's just being fair, well, for everyone. So there's something called PFICs, passive foreign investment companies. There's something called Subpart F, and there's also something which was recently created under President Trump's Tax Cut and Jobs Act in 2017, called GILTI, which stands for Global Intangible Low Tax Income. So it's a tax levied on companies controlled by U.S. persons outside of the U.S., particularly those companies in a lower tax jurisdiction. So we see a lot of it in where we operate in Singapore and Hong Kong, right? If you were in a high tax jurisdiction, for example, Europe, it perhaps is less of an issue than it is for those who are operating in a low tax jurisdiction. Now, in terms of how to legally avoid it, and I know the go-to response is, I'm going to get a nominee, I'm going to get a nominee. No, attribution rules mean that it really doesn't work, because what the laws speak to is share of value and voice. Value being shareholding, but voice. So even though you may not be on paper the controlling shareholder, and this is a big deal for people who operate in Bali, in Indonesia, or in Dubai, where you're legally required to, if you're having an onshore Emirati company, you need an Emirati. So you must have a nominee. But once you have that controlling voice, you are controlling the company, and it falls under GILTI. So that's the anti-deferral. You're going to be paying tax on money even though you have not extracted it from the company. It falls onto your tax return. How do you avoid it? Honestly, you can't. Honestly, you cannot. Now, you can minimize it. And there are certain elections that you can make where you can enjoy a lower tax than the default, which is your tax at your ordinary tax rates as an individual. So there are ways of minimizing it, but to legally avoid it means you're going to take on a partner who is a real partner, not a partner on paper, but a partner who is actively engaged in running this business with you. So yeah, I mean, there are people online who do whatever they do, but we are goody two shoes. We follow the law, and legally there's no shortcut, there's no hack to avoiding this other than doing it the right way. Next question: how to structure earnings in a foreign entity owned by a U.S. citizen living abroad? Do earnings carried forward needs to be declared, and what's the fiscal exposure there? So I guess that ties into the previous question. Anti-deferral rules, whether they be PFIC rules, Subpart F, and recently GILTI, mean that the earnings need to be declared in the year in which they earn, assuming it's a CFC, a controlled foreign corp. As we mentioned in the response to the previous question, if it is that you are really not, the company really is not controlled by US exposed persons, then it's not a CFC, and therefore it's not subject to these anti-deferral rules. And then yes, you can, assuming that you're in a jurisdiction like an IBC in Dubai or Cayman or BVI, whatever the case may be, theoretically, it won't be taxed. And you can reinvest, and you can plow back in those profits and reinvest and scale your business, and it will be taxable to you as a U.S. person upon receiving a distribution, either in the form of dividends or salary or bonus or something like that. So the key is to not have it be a CFC or controlled foreign corp, a company controlled by US exposed persons, and control being share of value and voice. So again, that nominees don't work, value and voice. That's a sure way. Now you can use Estonia. I'm sure if when I scroll down, somebody's going to be shouting Estonia, Estonia, Estonia. Estonia has a lot of fans, and I respect that. But the tax rates are pretty high. So you can, I mean, there are people who do it, seems like in perpetuity. They just never take a distribution and they continuously reinvest the profits. But when you do extract those profits, the corporate tax rate in Estonia is in the low 20s. Plus you're paying as a shareholder who's receiving dividends. So it is pretty aggressive when you contend that you have much lower tax jurisdictions. You have Bulgaria 10%, you have Ireland 12%, and of course you have tax free in other jurisdictions. So I guess it's you need to do some sort of sensitivity analysis, some sort of comparison. Is it worth picking a jurisdiction like Estonia, and there are others as well, where you're allowed to perpetually reinvest to avoid the guilty or the whatever? And but when you do pull it out, you're going to be stung, or you choose a low tax jurisdiction where it comes out. So there needs to be some sort of comparison done. So anyway, next question. What will be the best jurisdiction to be tax resident if we have the choice? No one size fits all. And I know when you go into chat groups, everyone is saying like Belize, or Panama, Uruguay, Paraguay, Estonia. The Estonia fans have, they want the little cards or whatever. It really depends. It really depends on who you are and the nature of your business. One cannot propose a solution. I think it's professionally irresponsible when people do it. Propose a solution without understanding your circumstances inside out. And which is why you find that the people who propose those things, they are one person shows working from the garage, which is fine, but it means that their exposure is limited. We have professional liability insurance, 7 figures, because we know when we make a mistake, there are serious consequences. And so we're very, very guarded, and we try to follow the rules and do the right thing. We see influencers who are not based in an advanced economy. They are not hiding, but they are in unregulated jurisdictions. So they won't go to Singapore, where they'll be held to account for giving bad advice. They may go to Malaysia. They won't be in Western Europe, where they would be held to account. They go to Eastern Europe. They won't be in North America. They go to Central or South America, as the case may be. So, and these are the people who say one size fits all. My point is it does not. We need to understand who you are, what residencies you have, because the residence can make a difference, what citizenships you have. What is your business model? We need to understand that business model inside out. Where are the key decision makers based? Where are your customers based? Where are you banking? Where do you want to bank? Because some jurisdictions I mentioned, banking is really difficult right now, and most banks as a default would be, we don't want your money if you're not resident in our jurisdiction. Why do you want an account? So it really, really depends. You need to sit with an advisor who understands you and your business inside out, and then you can work out your options. Now, there are some great options opening up as the world opens up in a way. On our website, HTJ.tax, I've updated it recently with, I think we put in today the 3 countries in Asia that are, non-essential travel has been locked down, but there are some jurisdictions where, with the right permissions and following the right immigration rules, you can be let in. So in Asia, Indonesia is open back up to foreigners, which means Bali is open back up for those who get the business or the social visa. Let's see, Thailand is open back up for long stay. And for those who get their Section 9 visa, I think for the Philippines, you can re-enter the Philippines now with the right permission. And the certain Caribbean islands have opened back up, your Antigua, I understand. I think Dominica is open back up, Central America. So there are places that have opened back up and that are welcoming, particularly US exposed people who were kind of blocked previously. Okay, someone else is asking, what if you're from the country of Venezuela? If you are from a country which is subject to certain sanctions, so Venezuela, Iran, and so on, obviously your options are slightly limited for where you as an entrepreneur would be able to set up your business. You would want to choose a jurisdiction without sanctions. So as to where Venezuela can go, I honestly can't say right now. Um, I think we need to probably discuss that offline. What would be your options? Because we need to check the rules to see what is allowed and what is not allowed. If you are in Venezuela still, then no one who is U.S. exposed really should be helping you, because it's against the laws of the U.S. to work with Venezuela right now. But if you are a Venezuelan citizen outside, legally outside of Venezuela and living and working abroad, then perhaps there may be an opportunity to work with you. So we can probably catch up offline. My email address was typed, I think Hannah typed it up. So if you scroll up in the chat box, you'll be able to reach out to me there. Next question. You seem skeptical about the e-residency possibilities offered to international professionals. Could you tell us some more about it? So again, my caution is that one size does not fit all, and it's hard. And I think it's professionally responsible to paint with a broad brush and say the solution for everyone is a Belize company and Estonian e-residency. So with e-residency programs in particular, it is not technically an immigration program. It is not, when you look at the definition of residency in a dictionary, it's not technically that. What it is, it's an ability to access government services, which of course is great. And Estonia has done a wonderful job of it. But as to whether it is the right jurisdiction for for everyone, I really think it depends on the facts and circumstances. I think any qualified professional would first want to examine the fact pattern and follow that through. And that not only goes for incorporations, it doesn't only go for banking, but also, residency, as in legitimate residency, where you, according to the immigration laws in a jurisdiction, have permission to stay there. So one size cannot fit all. And when we have people that may be driven by commissions, and sorry, let me just turn off. I'm getting a buzz in the back, right? When people are driven by commission and monetary incentives, sometimes that creates a bias. And it's natural, we're human beings, people running a business. If it is that I'm being given more commission by one incorporation agent over another, I need to pay my rent, right? I'm going to do it. Or if I'm given more commissions by one residence or immigration agent, I'm going to push people in that direction because I need to pay my bill. So I get that. But all I'm saying is that may not always be best for the client. And I think the client should always come first. Next question. How to deal with, I guess, foreign earned income exclusion for a foreign entity owned by US citizens living abroad? Not sure what you mean by the foreign income for foreign entity. So the foreign earned income exclusion, just to explain what it is a tax planning opportunity offered by Section 911 of the US tax code, which says that if a US person as defined typically by Section 7701, so it's either US citizen or a green card holder, or someone subject to substantial presence who, by nature of spending a lot of time in the U.S., they're a U.S. person for tax purposes, right? If it is that they are working abroad, then they're able to leverage this Section 911, which says that and it moves with inflation. So this year in 2021, as we're doing 2020 tax returns, it is 107. It'll go up next year, right? So you have 107,000 of your income that will be sheltered from US taxes, right? Now you can qualify for this amazing benefit in one of two ways. One, physical presence test, and everyone gets that by counting your days on US soil, and don't spend more than 30 days on US soil, then you will be able to enjoy the foreign earned income exclusion. The second way, so that's objective and that is quantitative. The second way is subjective and qualitative. What do I mean by that? It means that we're talking about the bona fide residence test. So in order to qualify under this, you need to basically your center of life or your personal situation must have legitimately changed from the U.S. to another jurisdiction. And there are certain questions asked in Form 2555 to evidence this. Like, where's your family? Under what visa are you in that foreign jurisdiction? More importantly, are you paying taxes in another jurisdiction? So anyway, so either one of those two bases, you can qualify for the foreign income exclusion as a person. So your individual, your earned income, not your passive income, not your investment income, but your earned income will be sheltered from the IRS legally using the foreign income exclusion. Now, this is separate from your company. The company that you own and you control, that's separate. In law, a company is a separate legal person from you with rights and responsibilities of its own. Your company can fire you, as Steve Jobs found out with Apple, right? So your company can fire you. It's a separate person in law. Now, the company does not qualify for the foreign earned income exclusion. You do. So I hope that clarifies. Moving on. The welcome stamp. Dwayne, good to see you here. The welcome stamp program rolled out in Barbados. It has been advised that the nature of the visa is that you would pay taxes in your home country. How does that work with a 183-day rule? It does. So Barbados is a curious example, right? Because with some of the other long stay visa programs, there is the taxability element. So if it is that you are on investment income, then that's fine. So typically they want to make it attractive to you. So they'll say, investment income. Okay, fine. You can legally avoid paying taxes on investment income that arises outside of their jurisdiction. But for a jurisdiction like Barbados to say, well, not just your investment income, but all of your income, you can work remotely, can work online, and it's all tax free. And that is unusual in the whole landscape. And on the face of it, it does seem to be a contradiction to the typical 183-day rule, where under normal tax laws in Barbados, I assume, typically once you spend 183 days in Barbados, you would be subject to taxes by the tax authority there. So it seems as if the tax authority has waived that right in order to make the visa more attractive. Now, that has implications to that visa holder in the sense of where is their country of origin. We said that with the US, it really doesn't matter. They're going to be paying taxes legally back in the US anyway. So, they're going to be taxed. For certain European countries and for the kinds of countries, so I'm including Canada, I'm including Australia, New Zealand, their tax authorities may, and they need to be careful here, the tax authorities may take the view that moving to Barbados for a year does not relieve them of the obligation to pay taxes back in their country of origin. They need to check with someone who's qualified on taxes back in their country to make that international taxes back in their country to help them make that determination. And similarly with certain European countries, as I mentioned, Italy and some of the other European countries would say, well, you're going to Barbados for 1 year, you still need to be paying taxes back home. We don't care. So I think it's really on a case-by-case basis. Each person who takes up that welcome visa, which I understand has been extremely, extremely popular, they need to assess their tax situation so that on returning to their country of origin, they don't have any uncomfortable discussions with their tax office. They don't want to get in trouble, basically, is the point. Scrolling down, does Venezuela have to pay tax on worldwide income? Sorry, I can't comment on Venezuela. There are certain rules, not by the tax authority, but by the Department of Justice. And being US qualified and US licensed and being a US person myself, I'm going to be in Miami in a couple of weeks. Sorry, I really can't comment on any Venezuelan who is still based in Venezuela. If you're living outside of Venezuela, however, then the question becomes, okay, well, you're no longer in Venezuela. Good. Where are you? And you must be somewhere. and wherever you are has laws. And that, so we need to follow the laws of the jurisdiction in which you now reside, in which you are now tax resident. So those are the laws that would trump, no pun intended, Venezuela. Even though you're a Venezuelan citizen, you are residing outside of Venezuela. So the first thing to pay attention to is, where are you presently resident? And then you mentioned a Belize IBC. No offense to the Belize fans, and I know there are a number of Belize fans, and no disrespect intended. The challenge with, and I believe Belize is off the blacklist, so which is a good thing, which is of course a good thing. The problem with the Belize IBC is, where are you going to bank? Very few banks want to touch a Belize IBC. Similarly with a Panama company, yeah, no problem. Panama, but Panama has been the subject of negative publicity. So you show up in particularly what I would call a tier 1 jurisdiction. You rock up into a US bank or Singapore or a European bank. Hey, I want to open a bank account for my Belize company or for my Panamanian company. Well, I don't think you will be warmly received. Of course, there'll be exceptions to that rule, but generally speaking, you may not be warmly received. So a Belize IBC is all well and good. Panama is all well and good, but think about, where am I going to receive that money? Where am I going to bank? So you will probably be locked out of a tier 1 and maybe some tier 2 jurisdictions. So you're left with a tier 3 jurisdiction, tier 3 bank. Is the bank reliable? When you look at the global index that scores the strength of a bank, is it a bank that's robust? Is it a bank that's going to be around in the future as we face economic uncertainties? Or is it one of those banks that's going to fold because, it's not strong enough? The reserve requirements, the reserves aren't there. So yes, you may get a tier 3 incorporation, but remember, it has to be paired with a tier 3 bank. So just always think about the pairing. And if you're prepared to handle that risk, then go for it. But there's a risk involved. Scrolling down. What are the transfer and pricing implications of structuring a US LLC owned by a foreign entity by a US citizen living abroad? Structuring transfer US owned by a foreign. Okay, so then it's a subsidiary relationship, right? So a US LLC is owned by a foreign entity. Now, just to loop everyone into that concept. So transfer pricing is, let's say, a discipline within tax and economics that deals with getting the correct price for intercompany transactions between related companies. So for example, if you own a foreign entity, like in this person's case, you may own a foreign company, and then you may, as in a non-US company, and you own a US entity, that's fine, no problem so far. But if they share certain services, so for example, there's a shared service in terms of accounting, there's shared services in HR, there's shared services in marketing, especially for digital nomads who, doing stuff, everything is online right now. Those shared services need to be priced in a way that, because where people go with this, where I'm going with this. If it is that you have two companies, one in a high tax jurisdiction, one in a low tax jurisdiction, naturally your intent is to shift as much profit as possible from the high tax jurisdiction to the low tax. I mean, that just goes without saying. And of course, tax authorities have known this for decades, and particularly those in advanced economies, and they are clued up, and they want to see documentation that evidences that the price charged for those shared services is an arm's length transaction. So if you need a comparable, typically you need to do a study, and those studies aren't cheap. I'd say ballpark, a decent study starts at around $20,000. But it's worth it for that, whenever it is that tax authority does challenge you. And right now, along with taxes for online transactions, transfer pricing, I think that's the cutting edge of where tax authorities are paying, giving attention, because they believe that there's a lot of money to be made in collections in those two spaces. Companies that have been involved in shifting profits to low tax jurisdictions, and companies that are using the internet to avoid taxes completely. So, to answer your question, if it is that you have two companies and they are involved in, they're both owned by the same shareholder, you presumably, they have common shareholders, so there's common ownership, and there's shared services or shared transactions, or maybe one is producing something which the other is buying or selling, or whatever the case may be. You need to take advice from someone qualified and competent in that jurisdiction to make sure that you have the transfer pricing documentation in play, so that when the tax authority knocks on your door, you're prepared to answer them. That's that. Scrolling down. Well, this is a long one. To be legal, if to be legal and proper, one has to be based in a sovereign country and pay taxes there, as in the case of the DJ earning in a region and not being able to repatriate the money. So usually, depending on a person's work and opportunities for livelihood, the country would thus be chosen. Correct. Depends on the individual, their circumstances, depends on the nature of their business. I'm with you so far. My question is this. Let's say in South Asia, South Africa, or Latin America, where countries are good to be based, where when monies are being made online or from various countries in a region. Revenue is not confined to domestic, but from a wide network. So I'm scrolling down. Oops. Okay. So your question has been cut. Has been ALTE. Okay. Your question, I guess it was too long to fit in that little box, so I can't see what the actual question is. But let me see if I can figure it out from what you have written. So let's say you're in I guess, an emerging market, so like South Asia, South Africa, Latin America, and you're making money online, but revenue is not domestic, but it's international. Well, those countries that you mentioned, so if you're in Southeast Asia, you're in one of the ASEAN countries, uh, or South Africa has one of the most aggressive tax authorities in the world, and they're becoming even more aggressive. And I guess Latin America is kind of like, it's a mixed bag. The point is, if you are working online, you're working online, running a business online. And that's why I think, the whole idea of a technology company is redundant, because every company needs to have technology on its core. So, I mean, you're running a typical company, which means that using technology, you're doing something on the web. Remember in the slides, we spoke about the concept of nexus. And then we spoke about the place of effective management. Even though you are doing something online, management and control is being exercised somewhere. You are resident somewhere. You're living somewhere. If you're a resident in South Africa, if you're sitting in Bali, if you're sitting in Colombia, you are running a company online from that jurisdiction, even though you may not have any clients in South Africa, even though you have no clients in Bali and you're sitting in Bali, even if you have no clients in Colombia and you're sitting in Cartagena, Medellin, it doesn't matter. You are running a business from that jurisdiction. You're spending time there. You may be tax resident in that jurisdiction. It doesn't matter that the money is being collected in another country, in another bank. It doesn't matter that the company is incorporated in another jurisdiction. You, as a key decision maker, you are there. So therefore, legally, that company has already been pulled into the tax net of South Africa, of Indonesia, Bali, of Colombia. They already have a legitimate right to tax that company and deem it to be domestic, because the place of effective management is local. And so that's where I say, One size doesn't fit all. And I tie this back to the previous question being asked. One size does not fit all. And for those who want to paint with a broad brush, the answer to everything is Belize, the answer to everything is Estonia or Panama, whatever the case may be. It really depends on the individual circumstances. Tell me about that individual. What is their citizenship? What are their residencies? Where else are they legally resident? We need to find that out. We need to find out the nature of their business. Where are their customers? Where's their economic? Where are they banking? Where are their suppliers? Where are they warehousing? Because warehousing could create nexus as well. So once we have the picture of that individual and the business, we can make an informed choice. But otherwise, understand that the whole concept of nexus means even if your customers are not in the country where you are, even if the money never comes in, sometimes that makes a difference. So for example, I know with Thailand, that does make a difference. If you're under the remittance basis in Ireland or in the UK, if you're res non-domini claiming remittance basis. So, okay, generally speaking, right? Generally speaking, you're running a company from that jurisdiction. Even if you're banking somewhere else, even if the customers are somewhere else, the place of effective management is that jurisdiction, and that jurisdiction typically reserves a right to tax you and tax that company as well. Scrolling down. Resident of El Salvador, and my company is in El Salvador, is exempt from taxes. Okay. All right. So you're a resident of El Salvador and your company in El Salvador is exempt from any taxes. Okay. I'm not seeing the question, but that's okay. Any other questions? Please feel free to write in the box below. And the few minutes we have left, please feel free to follow us on social media, on YouTube. On YouTube, LinkedIn, Facebook, Insta, Twitter. We update daily. I post a video every day with a video that is not more than 1 minute. I try to keep it to 1 minute with a useful piece of advice, a useful piece of education to help you make an informed choice together with your qualified advisor. So we post a new video every day. We do webinars probably every week, at least one a week. We did one last night. This is the second one. So we were pretty active online, providing information for people who want to make the right choice. Because as you know, all over the world, governments are strapped for cash and they definitely need to pay for their expenses somehow. And they're looking at you as entrepreneurs, they're looking at you as business owners, and they're seeing dollar signs. What do you think about cryptocurrencies in terms of taxation? There are some great jurisdictions to be based in terms of crypto. There's Portugal, there's Malta, there's Singapore. Of course, I need to, Singapore is pretty advanced in its understanding and incorporation and embracing cryptocurrencies. So there are some jurisdictions that are great to be based in, but again, you need to think holistically. If you're like 100% crypto, that's one thing. But most entrepreneurs we deal with, they're diversified, right? Yes, they have some of their wealth in crypto, but they're also running a business. They're also doing this, they're real estate, whatever the case may be. So there are some jurisdictions that treat crypto well, but you have to look at the other side of the coin, right? How do they treat your other asset classes? But if the only asset you own is crypto, then yeah. But you have to look. I would say look holistically at everything. But of course, this applies to non-U.S. persons, because if you're a U.S. person, well, the IRS at this point in time sees crypto as an asset, as property. It doesn't see it as a currency, as Portugal does. Portugal, for example, sees it as a currency. I think Switzerland as well. So if it is that, it depends. It depends. One size can't fit all. Depends on your personal situation and your business, your wealth. Oh, we have one more question as we approach the top of the hour. As a U.S. citizen living in Indonesia and conducting business online with international clients, how to optimize the worldwide taxation required by Indonesia and avoid double tax? Well, as you intimated, Indonesia does tax you on your worldwide income once you're deemed to be tax resident there. And historically, they have been more or less turning a blind eye, but within recent times, there have been high profile cases where the tax authorities have been proactive on foreigners who are being based there. We've seen some photographers. I mean, it's quite common. Photographers in Bali who are obviously doing some sort of shoot. They're being, questioned and so on. And when I visited the U.S. embassy in Jakarta, someone, a consular official, did tell me that he has one or two members of his team. They seem to be almost permanently dedicated to getting U.S. persons out of trouble when they're in Indonesia working without permission. So, but anyway, you see where I'm going with this. You need to register. You need to get your KITAS. You need to register. You need to properly pay your taxes in Indonesia. You need to do the right thing. Now, there's a double tax treaty between Indonesia and the U.S., but you don't necessarily need to rely on that because the U.S. does, as you probably know from doing your tax returns, there's Form 1116, which gives you foreign tax credits on taxes paid in Indonesia. So you will not be taxed twice. Once you have a professional, once you have a team that knows what they're doing, I repeat, you should not be taxed twice. You should not be taxed twice. No need to worry about double tax. But Indonesia does have the right to tax you on your worldwide income if you are a resident in any part of their jurisdiction. Exceptions, of course, to the rule. Yes, you could. I think there's Batam and Bintam, or there are some special economic zones where they have their own tax, but I see very few that they attract people into like manufacturing and some tourism related stuff. So I'm assuming you're not in any of the special economic zones, that you're in some one of the other 17,000 islands in Indonesia where you're subject to the regular tax regime. You will be taxed on your worldwide income. And no, you will not be double taxed once your team knows what they're doing. And with that, I thank you for your time. I quite enjoyed the engagement. As always, please have a look at htj.tax, where we have upcoming webinars. I think we have 8 or 9 upcoming webinars on the website. If any of them interest you, please feel free to join us and let's continue the conversation. Have a good morning, have a good evening, have a good night, have a good day, depending on where you are. We'll see you next time.
Here are 4 ways we can help you. Number 1. Sign up for free webinars on US expat taxes and international entrepreneur taxes at www.htj.tax. Number 2. Stream premium educational videos at www.htj.tax. Number 3. Contact us for tax optimization consult over Zoom. Number 4. High net worth? We can quote for doing your US international taxes returns. Our books and upcoming event are available at htj.tax. Please subscribe, like, share, and comment below. Email us at help@htj.tax to engage us, to advise on international tax or business matters.